All right. Welcome to our August investment outlook. Good morning to everybody joining us in Europe, and good afternoon to everybody listening in from Asia for our August investment outlook live stream. Great to have you with us again. Our theme this month is crypto's summer surge. The crypto market cycle has further room to go and to grow. It has been a little bit of a stable coin summer driven by a lot of action in the market. And together with my colleague Katalin Tischhauser, Sygnum's head of investment research, I will unpack the biggest macro and crypto market drivers that have been shaping August so far. As always, all content and opinions in this live stream do not constitute any investment advice. And with that, let's jump straight into our topic number one. And of course, we'll start with the macro, just like usual. And when we look into the macro environment, we would rather say unpopular opinion, and that is the state of the US rate cuts, because we're of the opinion that they might not come anytime soon. The US administration continues to push for a September rate cut despite poor economic data and sticky inflation. Why might such a move backfire in the current environment, Katalin?
Yeah, thank you. And I'm not even sure that it's an unpopular opinion. It's definitely an uncommon opinion out there, just looking at the rate cut probabilities, which are still very high since the jobs data that disappointed to the downside. The probability doubled from 40 to 80 and then basically went to 100% for a while. And since the very negative surprise on inflation, it's now a little bit less, but still super high. And the question I ask is, why would there be a rate cut? And there's two questions there. Is there actually a need? And will it achieve what people think it will achieve? And on both of those counts, I think potentially differently than the market consensus appears to think. The idea is that rate cuts are needed to stimulate the economy. Now, whether they're needed, I think is not that clear. There's actually, despite the jobs data, the economic indications of the underlying strengths of the economy are not that dire. Now, obviously, the Fed has to be ahead of the curve, not behind the curve. But what we could see just now, against the backdrop of actually not bad data, decent earnings, GDP growth, it's hard to tell where GDP growth is because the tariffs brought imports forward and then used up the inventory. So we had these very statistically aberrant numbers of minus 0.5% in Q1, then +3 in Q2. But it's roughly about chugging along at 1.2% or maybe even higher. But more importantly, now that the tariff stuff is getting sorted out, a lot of the pose of companies kind of being on hold, not investing, not knowing where to go, a lot of delayed investment could actually happen now. So I think that the need is not at all clear in terms of the underlying growth trends of the economy, and the inflation trends are very negative. It's going up much more than people thought it would. How far will it go? We'll have to wait and see. And, Powell has definitely said he wanted to wait and see. But what is even more important to my mind is that if they did cut, would that stimulate the economy? Because actually, what it would achieve maybe is that money market funds, if the rates are kind of too low and everything else looks okay for risk assets, then maybe there's a shift into risk assets. But the underlying economy, it hinges much more on bond yields, business loans, mortgages, and so on. They're at the long end, not at the money market end. So the question is, what will bond yields do? And in the face of a lot of inflation already, and clearly the trajectory pointing upwards, I think rate cuts could be counterproductive in that bond yields could rise. And bond yields are already fairly shaky. The bond market has been very upset by the failure of Doge, the Moody's downgrade, and just the kind of spiraling US debt and budget deficit and so on. So everything is in a much worse shape, let's say, than a year ago when the Fed started cutting rates. And even then, the actual result was steep sell-off in bonds, rise in inflation, and growth contracting, slowing down. Now the backdrop is worse because then inflation prior to that was falling. Now it's already actually accelerating upwards, and the bond market is much more shaky. So I think it's quite likely that if the Fed did cut, it would have not a stimulative effect, but a contractionary effect, and plus be inflationary. So the other question that people ask is, of course, aside from the macroeconomic fundamentals, where I think it wouldn't make sense if they did cut, it probably wouldn't do what people think it would do. It would probably be a negative. But the other question is, why is there so much pressure from the administration, as clearly there is, and will Powell yield to that pressure, right? So even though it doesn't really make sense, it probably wouldn't do any good, but because of the political pressure, including, threatening him with, I don't know, impeachment because of the renovation of the building or whatever, and just the constant pressure, would Powell yield? Now, I see no signs that Powell would be yielding. He's going to speak on Friday. Maybe we'll hear something different, but so far Powell has been a steady pair of hands, and I have seen not an iota of a sign that he would be shifting. And also, even though there are more and more, there's another Trump appointee among the Fed governors now after the sudden resignation, they're still in minority. So it's, people say that this will shift the balance, but it's not shifting the balance, as in shifting to majority. So I think it's unlikely. I'm not even sure why this pressure exists from the administration, to be honest, because obviously economically it probably wouldn't make sense, and it's not even necessary. There's a lot of liquidity around globally, as well as in the US. There's many ways to provide liquidity that can be much more effective under the current circumstances than an actual rate cut. So it's likely to be, maybe that they want to refinance a lot at the short end in terms of government debt that's coming due for refinancing, or maybe as Powell's term is going to expire next May, and he's obviously not going to be renominated. That's clear now. That maybe he's lined up to be the scapegoat for any potential economic problems that lie ahead. So it's not clear, but I think net, I think it's unlikely. I wouldn't even think it would be good news if there were a September rate cut. Maybe later on the economic picture changes, the inflation eventually slows down. Tariffs are kind of a one-off hit in many ways. We just don't know yet how far it's going to go, because until now it's been swallowed to a great extent by the importers. But as far as the markets are concerned, I think the markets are in a good shape anyway. Obviously, there could be short-term disappointment, but liquidity is plentiful. And if you just think about how many rate cut disappointments the market has swallowed in the last 2 years, throughout like a big part of last year. And then also this year, it was going to be, a June cut, a July cut. And then the market just kind of resigns itself to zero probability, and the rate cut doesn't happen. And we have seen more all-time highs in the last 2 years than I've had hot dinners. So that's clearly not been standing in the way of this current cycle continuing further, which I think it will.
Yeah, and you made some super interesting points with respect to also like why this administration is applying the pressure, right? If you think about it, like the administration is still in place for 3 more years, right? And we have midterms in a year and a half coming up. Like this might all just backfire. A too early cut might lead again to a bit higher inflation, so it will have an impact on the voters' pockets, what to buy and how to buy it. And even if you're able to refinance that now on the short term for lower rates, in a year from today, you might have to refinance that if you refinance it at the short end for higher rates. So that political pressure that is coming from the White House and from the Treasury, also where individuals are, it's very interesting to see. And
I agree with you, and I think maybe the pressure on the budget is just so great that it's kind of a priority.
Right.
and especially after the disappointment on cutting expenses and the big beautiful bill bringing just more of that, and the debt ceiling raised again, and what we mentioned, the Moody's downgrade, and so the market reacting very negatively. Maybe that is just the priority to firefight.
Yeah. Okay. Yeah. Super interesting. And the budget, on the budget side, that ties us into our second topic right away, and that's the tariff situation, right? Something that has, of course, been part of the macro story for the last 4 months, ever since April. And it seems like all of this has slowed down a bit, right? And our second topic is tariffs. Are they divorced from economic policy and market reactions? It seems that Washington's tariff policy is increasingly detached from its economic goals and more tied to geopolitical aims, right? To what extent do markets start shying away from this tariff story, what it seems like they do?
Yeah, I mean, it's, the tariff story is I think it's now increasingly in the rearview mirror, and that's a good thing. And even for a while now, the markets have traded them as what they call the taco, that, Trump always, that basically it won't happen. All these things that are being threatened will not actually happen, so just ignore. I mean, the geopolitical aims were obviously not achieved, not in terms of, threatening China, who had the stronger hand all along, because of the US's extreme dependence. Every time the US threatens China with more tariffs, like they did again recently through, just countries that buy Russian oil will get 100% or 500% tariffs. China immediately cuts the rare earth exports, and then the tariff toll goes away. So, but also this greater cohesion amongst the BRICS. Like the BRICS used to be a fairly vague, loose, not very focused grouping, if you could even call it that. And what drove them close together and what created the cohesion is the US putting economic pressure on various countries around the world. So they had a compelling incentive to develop alternative trading systems, alternative payment and settlement systems, move away from the dollar, and so on. So it's exactly the US using its economic power to pressurize countries, what is creating a greater and greater BRICS cohesion. So when there are more tariffs threatened with these geopolitical aims, and for example, now India was seen as possibly the weak link, and so the tariffs went to India, but there's so many carve-outs that it's probably nothing. But it didn't achieve. It achieved the opposite goal. The BRICS are pulling even closer together. Certainly, none of them agreed to cut trade with Russia or any of that. But their cooperation is accelerating. So this has been not just ineffective, but I would say counterproductive. But then the US reverted to the secondary goal, and that ties back to our previous conversation, which is raising revenues. So tariffs do that. Tariffs are currently the highest, maybe ever, or something like that, in the US. And definitely, maybe the clearest example that revenue raising is such a critical primary goal now. For tariffs is what happened to Switzerland, right? There's 39% tariffs for no reason whatsoever, and no one understands, and no actual explanations given. And Trump gave the explanation. He said, Switzerland's a rich country. I take the money where I find it. So I think that, and that is definitely helping. For example, I mean, there is, it's helping the budget. How much is it helping? It's really relative to the US debt that's growing incredibly fast. It's a drop in the ocean, frankly, but it is helping right now. The optics are certainly good. The S&P confirmed the AA+ rating just yesterday or something like that the other day, and acknowledging specifically that there's revenues from the tariffs, and that's helping, and that's a good thing. So and now I guess the next move is there any reindustrialization? Despite it being the number one stated goal, I think it was at best the number 3 goal of this whole tariffs project. But it is, of course, it is one of the desired goals. It's just not been the focus. And now maybe that's coming a little bit more into play. Now the trade agreement, not even agreements, just frameworks with the EU, Japan, and so on, that compel these countries or regions to invest in the US. I think that's fairly flaky, because the agreements are very loose, and the EU already said, look, it's private companies that have to invest. We can't make that happen. We can just advocate for it and suggest that companies do it, but we cannot guarantee that this will happen. And it's similar in Japan. So I think that is not very powerful, even though it's part of this framework. But what is maybe working better is US companies. So saying, you can get relief from whatever tariffs if you invest in the domestic market. Apple, for example, straight away invested 100 million. And so there could be reindustrialization to a degree coming. And now that there is much more clarity, not full clarity, but quite a lot, I think we could see some of that. And the China situation looks like it's good news that it's a managed divorce. It's a gradual, slow. They just keep postponing, which is the best outcome. The US's extreme dependence on China had to be cut, and China understood that for a long time. Both sides understand that this relationship has to be unwound. But if it's done, of course, in a very abrupt, dramatic way, then the consequences are very negative. If it's done in a managed, gradual way, then that's a best case scenario, which is kind of what we have on this front.
Yeah. Okay. Yeah. And markets were able to digest all of this over the last couple of months. And
markets like it. Markets like it, and I think they like it for the right reasons. I think there was this big shock, and ever since then, it's actually working itself out in a reasonable way.
Right, exactly. Yeah. All right. Yeah. Let's switch gears a little bit and focus on the crypto side of things. And contrary to previous live streams, we'll start with Ethereum this time, just because we have to. So it has been Ethereum summer, it has been stablecoin summer, on-chain activities. Wall Street's finest have moved further into this space together with the largest investment managers of this world. It has been super busy. Treasury companies, stablecoin legislations, ETF flow momentum, and Ethereum ETFs. So over 5 billion of inflows just in July, and a record daily inflow of above 1 billion just in August. How much of Ethereum's or Ether's rally is being driven by certain fundamentals, such as the Petra upgrade, stablecoin legislation, versus like the short-term trading of ETF, the ETF momentum, and short-term traders?
Yeah, I mean, I think it's been so powerful and so steep, basically 3x, because it's both. The fundamentals really were there, Ethereum sensing their crisis, rejigging their development roadmap, refocusing on driving revenue to the layer one, that kind of philosophical change that the market acknowledged. The revenues after Petra increased, the fee income and revenues to Ethereum increased substantially and clearly, and it's been sticky ever since, so it's kind of real. And there's also the very powerful narrative, which was always true, that Ethereum having the largest market share across use cases, and the greatest blue chip security, that it's quite likely that TradFi will favor it, and so on. These kinds of narratives, this was always true. But suddenly the narrative started focusing on it, having ignored it for a long time. And the stablecoin summer, as you mentioned, or the focus of stablecoins, Ethereum really seen as we'll see how things will actually work out, but definitely currently seen as the primary beneficiary of this use case that's really powering ahead currently. And then it's also supported by certain opinion leaders, and Ethereum also found its, let's say, Michael Saylor or its strong advocate in Tom Lee, someone, a respected opinion leader who's really advocating for this narrative. So all of this had an effect, but it's also to some extent just flows, right? Because the Ethereum ETFs, I mean, we certainly always expected that the inflows will come with a delay, that TradFi, these new types of investors were just digesting what Bitcoin even was, and it just came too soon and too suddenly for them to focus on it, understand it, get the approval, so that there was going to be a delay. And this kind of dovetailed the fundamental changes, and then these approvals, which were going to take a little longer, and they're kind of happening at the same time. And then the big fuel, the Ethereum treasury companies. And again, Tom Lee is, that's why he's sort of a little bit like, like Michael Saylor for Bitcoin, but they took off so fast. It took, I think, for Bitcoin treasury companies, which, was obviously primarily MicroStrategy, especially for a long time, took like 3.5 years to accumulate 2% of the Bitcoin supply. And the Ethereum treasury companies got quite close to 2%, like 1.8% or something of the Ether supply in 6 weeks. So that obviously was tremendous buying pressure, driving the prices up, and all of these things basically combining to what we have seen, the price action. And a lot of it is solid and fundamental. The treasury companies will never sell, unless whatever black swan, but basically it's not like the ETF where you sell the ETF, you sell Ether behind it. Here it's a case of, you buy it, you hold it forever. And so that's all good news, and that's all solid, and that's, that remains in place. The only kind of words of warning, of course, when you have a 3x run in a short space of time, you should expect corrections. I guess that's not a big deal. We have seen now some outflows from the ETFs. That wouldn't concern me. What is more concerning is that we have seen selling by crypto insiders for a while. So kind of as TradFi was buying Ether and the Ethereum story through the treasury companies and the ETFs, long-term crypto, long-term holders have been selling into that, and the Ethereum unstaking queue grew to kind of the longest since when they first introduced it, and then the queue was long, then they worked it off. And the other sort of word of caution is that both Tether and Circle are building their own stablecoin specialist chains. So by far the two biggest stablecoins are actually building layer 1 blockchains that will be tailored specifically to be highly efficient at processing, serving the stablecoin use case. So that is a threat to, if this was a stablecoin summer for Ethereum, and it was more than that, and it is more than that, but to that extent, there's a question mark there, and of course, even more, I think, for Tron, which is, hinges so much, its revenues hinge so much on stablecoin revenue. So that's also, these chains are getting funded, and then they're gonna, over time get launched, and then we'll see if they take market share. But that is something to keep in mind.
Right, exactly, yeah. And while they're being launched, they still have a road ahead of them, right? They need to build the infrastructure, they need to build DeFi. Having a stable coin is one thing, but then using it and getting a community to use it and adopt it is another case. But it can go quickly, as we've seen, and I guess the market will tell us where this goes.
Yeah, I think the, Ethereum obviously correcting a bit, narrative is still firmly in place, just some words of caution, looking further. I would say I'm not bearish.
Of course, yeah. And I'll bring up a topic that we were going to talk later about. Well, I'll bring that up a bit earlier, and that's treasury companies, which you mentioned, right, with Tom Lee. And this seems to be a trend that is continuing. You talked about a bit about Bitcoin, Michael Saylor, of course, and after Bitcoin being adopted by corporate treasuries over the past years, now there are Ethereum treasury companies popping up. What's your take? What's next? Solana, Avalanche. And where does this go? And what's actually fundamentally long-term, sustainably relevant in your opinion when it comes to treasury companies and this trend?
Yeah, I think it's a very legitimate trend, and there's actually, it's being done now on more and more and more, a growing list of tokens, all sorts of Tom Coin and I mean Solana obviously for a while ago now, and I think even before Ethereum and Hyperliquid and even some meme coins and so there's a lot of it, and it's basically it's a product that transmits demand from investors that can't or don't want to directly access the crypto market. Basically, they buy these shares instead of buying the underlying crypto. So the question is always, sometimes, do they do that because they can't buy the underlying crypto because of you would need approvals or you would need whatever. Even if you buy the ETF, let's say you're an institution, you would need the approvals internally that this is a new underlying asset. When you buy a stock, you're just buying a stock, right? Like we've been buying stocks forever. There's no special kind of approval required. And then also because these companies have been able to, as long as these this positive spiral is in place of high premiums relative to their NAV in the token, the share prices have been accelerating very fast. So that also then it outperforms the underlying token, and so then it's also more attractive as long as this trend keeps going. So I think it was a very kind of a smart demand arbitrage and made a lot of sense. In a way, it's kind of an alt season. It's I think retail investors are buying these stocks instead of buying altcoins currently, and they're also buying sort of meme coins and other things that that retail gets into in later in the market cycles. They're not so much buying altcoins, to be honest, like we have seen before, but in this way indirectly they are, because this is then transmitted into demand and also takes the supply out of that token kind of permanently. So the question is just, and currently this trend is still in place. They're still raising a lot of funding. The fundraisers are still fairly successful and the amounts are large, but this will not last forever. It's impossible that this trend would last forever. So I think the question is just, when will we see signs that the trend peters out? There are some subtle signs. So certain fundraisers that we're going to close by Wednesday, and then it doesn't, and sort of it takes a couple of weeks. So there are certain signs that maybe slowly the trend might be saturating. Also, MicroStrategy has been also issuing basically vehicles that are riskier for the company, because it's more straight debt, where they definitely will have to either keep raising new money or sell Bitcoin, which would be a sacrilege. But I don't see a threat really very much to the market. Eventually this trend peters out fine, then it doesn't make so much sense to buy shares instead of buying. It's better to buy the underlying token. Why take the risk that this could go to a discount, which they could and they probably will, and so on. I guess if I'm concerned, if I could say that, it's more just that this has been such a strong driver of demand, and this will run out. So then, that demand driver will kind of exit the stage, but without, causing any sort of problems. These projects are holding. They'll be holding the tokens. They won't be dumping it, and there can be, of course, very negative scenarios one can imagine, but they're not very likely, and it would kind of take a lot. So it's more just watching for how this trend starts petering out. For now, it's still in motion. So that's just looking further ahead. Right now, we see still big fundraisers by these treasury companies. So it has some more to go.
Okay, interesting. Super. Yeah, and we'll continue monitoring this trend. Super interesting to see.
It's one of the things to really, really watch right now. Maybe one of the most important things to watch is the inflows and the buying pressure and how that's evolving.
Okay, yeah, super interesting. Yeah, great. We'll definitely keep an eye on it, and we'll talk about it here. One asset we usually talk about a bit earlier in this live stream is Bitcoin, and with Ethereum and everything, we've set this a bit up. But when it comes to Bitcoin, I think price trends have been a bit sideways, but we really wanted to focus on one thing that entering the year 2025, we had a lot of discussions on central banks potentially buying Bitcoin, right? I mean, this momentum seems to have vanished, and and whenever momentum vanishes, it seems like, might be a bearish trend. Or is this truly off the table for a lot of central banks that they look into buying Bitcoin? What's your opinion?
Well, I like you say, the signs haven't been great, right? And this was a great hope, and I think such a hypothetically or potentially excellent use case for Bitcoin. I do think that it has its place alongside gold. In what ratio, one can question, but there's a lot of reasons why that would make sense. Except that the way things have evolved, this may no longer make sense for central banks. And in terms of the signs you mentioned, I mean, obviously we have seen just a lack of progress other than developing countries, making announcements that they're going to do it, but that doesn't really have a big impact on Bitcoin and the Bitcoin price. Maybe some Caribbean islands, implement that. That's if the US does it, and then various other major countries, central banks do it, that's a massive use case for Bitcoin, and incredible price appreciation has to follow if that happens. And now we saw, first of all, the US government made various announcements that they're working on adding to this reserve, which is just to seize Bitcoin in budget neutral manners, which is the only way they're allowed to. And the announcement is coming, the market's gonna love it. We're about to do it. We're about to do it by Friday. We kept hearing this mostly from Bo Hines, who was kind of the point person in the US administration, but it never happened. The expectation was raised, but then nothing actually happened. And now Bo Hines resigned. He actually joined Tether as an advisor, but he suddenly resigned fairly, I would say, unexpectedly. And then Scott Bessent in an interview said that we will not be buying Bitcoin. Now, that this, of course, the market reacted very negatively, and he then backtracked and put out a tweet to say, no, we're still looking into it. We're still looking into the budget neutral ways of doing it. But, the body language is not very promising, on that. And I think fundamentally where I see a genuine problem is that a small US company, I mean, it's bigger and bigger because of its Bitcoin holdings, but as an actual company, very small, holds 3% of the Bitcoin supply of all Bitcoin issued, and in terms of the liquid supply on exchanges, about a third, and keeps buying more, getting to a half. So for any central bank to be beholden to a private company whose actions could dramatically affect the finances of the government is inappropriate. So I think that this Treasury company story, which actually has so many benefits and in many ways makes a lot of sense, the fact that there is one single company, it's not even the Treasury company trend, just that there is one single company that has such an influence potentially on the price of Bitcoin. Hypothetically, they say they never sell, but if you're the Chinese central bank or the British or the Bank of England or whatever, is it prudent for you to take that risk? So I think that this might be the lever and maybe the obstacle, and some kind of unless this is somehow worked out, it's hard to see that major countries' central banks would go for it, and the body language is that they're not.
Yeah, so that describes the status quo as of today, right? And who knows where this leads to 5 to 10 years from now. All right, and that brings up to our last topic, not central bank related, but regulation related, right? The SEC and Project Crypto. Of course, we've seen tons of clarity with the White House, the SEC, and the CFTC proposals setting rules for DeFi, staking, and token launches. And of course, it seems all to be tailored towards a long-awaited alt season and capital rotation into smaller tokens. Is that what's coming? Will this clarity finally fuel the alt season, Katalin?
Thank you for asking this as the last question, because it's nice to finish on something that's really bullish.
Okay.
And which I think this really is the SEC's Project Crypto, obviously coming on the heels of the White House white paper, or I'm not sure, the White House paper that they were ordered 180 days to develop proposals, and this was now released. Actually, that paper disappointed in the sense that initially that was meant to have a strong focus on the Bitcoin reserve, which was barely mentioned. Just coming back to your previous question, in fact, the only place where it was mentioned, it diluted the language of the executive order, which said, see, Bitcoin will never be sold, and now it says it will generally not be sold. So in that sense, the paper, the market wasn't so excited about, but then there were all these policy suggestions of what sort of regulatory and legislative framework the White House would like to see for the crypto industry and various segments of the crypto market. And then the SEC and the CFTC immediately jumped on it. They're also collaborating, and the SEC announced their Project Crypto. And that's very positive, very, very bullish. They're really cleaning house like they said they would, but now it's happening. The liquid staking has been declared that it's not, it doesn't require registration with the SEC. And they're suggesting various things, for example, safe harbor for developers, which is somewhat contradicted by still this Tornado Cash developer being convicted. But of course, the SEC, it's not an SEC case, it was a DOJ case. So, I mean, there's limitations to, how far this goes. But as far as the regulator can make the environment as supportive and positive for the crypto industry, I mean, as far as I can see, they're really on it in every way, in clarifying the status of crypto assets, the disclosure rules, and make it very feasible and easy, and then specific focus on tokenization, creating, there's big questions around tokenization. And the biggest question, I would say, is the legal title and your right to vote, which you have when you hold the share, but currently not when you hold the tokenized share. And I think this could be a major stumbling block in terms of moving everything on chain, that the efficiencies probably wouldn't outweigh, when companies invest, especially large institutional investors, in a stock, they wouldn't want to give up their voting rights. I think this can be a stumbling block, but regulation can solve this, right? So regulation can spec things out that kind of make all of this feasible and workable in practice. Currently, it's not really workable in practice. But if there's a way, then that could, of course, really help unlock that use case. Then, of course, they're focusing on stable coins and so on. And like you say, because of all this clarity, it could accelerate innovation across use cases and beyond stable coins and tokenization. And if it does, and there is real growth, real fundamental growth in decentralized projects taking market share and growing, that's our real alt season. Kind of a small hype where the high beta tokens outperform briefly, sure. But to have a strong, lasting, carries on for a while, lots of projects are involved. I think the SEC's actions, and of course the clarity, bill legislation as it kind of goes through, but this whole package and the CFTC, there's a potential that it could unlock a real fundamental alt season and a revival of various use cases and new use cases appearing and so on.
Right, yeah, and maybe we've seen the beginnings of it over the summer. So I guess the fall and going into the winter going into year end will provide more clarity on that. All right, thank you very much, Katalin. That's it for today's August Outlook, I would say. Thanks to everybody for joining us on another action-packed session. For the full August investment outlook, please visit our Learn section of the Sygnum website under Research and Education. Feel free to follow us and stay connected with us on LinkedIn and other social media channels for our latest launches, news, updates, and research. We will see you, and you will hopefully listen to us next month again in September for our monthly live stream. So thanks a lot, everybody, and see you next month.